Hello, everyone. Hello, everyone, and welcome. I'm Dee Dee Bloom, Advanced Planning Coordinator here at Elevate Wealth Advisory. We're so glad you're joining us here today for our monthly educational webinar. Today, our topic is long-term care insurance basics. For those of you who are new to us, Elevate Wealth Advisory is a full-service wealth advising firm located here in Athens, Georgia. We are founded 40 years ago by Chuck Vickery as Vickery Financial Services. Since then, we have grown to a team of 11, and we have rebranded as Elevate Wealth Advisory. We are now led by our president and CEO, Deanne Rosso. Before I introduce our speaker, I have a few housekeeping items. Betsy Kenyon, our marketing coordinator, is here with us and will be monitoring questions. There are 3 ways to ask a question. You can see them all at the bottom of your screen. You can either put them in the chat box or the Q&A box, or you can also raise your hand by clicking the little hand icon. We will take questions at the end of the presentation, but if we don't get to your question, you can also email Betsy at marketing@elevate-wealth.com, and we'll be sure to get back to you as soon as possible. We will also be recording this webinar, and at the conclusion, you'll receive a link to the recording. You're welcome to share it with friends and family, as we have found that these discussions can be helpful to share with you if you have siblings you're working with to plan a parent's long-term care, or if you have children that you want to bring into the discussion about your care. Now, I'm thrilled to welcome our speaker, Brant Steck with First Element Insurance Planners. As managing partner at First Element Insurance Planners and vice president of BUI, Brant's goal is to make it comfortable and easy for our advisors to engage our clients in the areas of insurance and risk management. He often participates in joint meetings with our advisors to develop planning recommendations, commonly employing life insurance, long-term care insurance, and long-term disability income insurance. After graduating from Truman State University, Brant began his career in the insurance industry at GMAC Insurance and then AXA Advisors before finding his home at BUI in 2008. So welcome, Brant. I'll let you take it away from here.
Okay, well, thank you very much for the nice introduction. I'll go ahead and share my screen here. Can everybody see that okay? All right. Well, I think this is a very important and timely topic, and I say that for a couple of reasons. Number one, 87% of Americans underestimate their healthcare costs in retirement. That's a statistic that was just recently put out by Fidelity Investments. In addition, we have a very large population, being baby boomers, on the doorstep of needing care, and the number of people providing caregiving is dramatically shrinking. In addition, the likelihood of needing care is growing. People are living longer, and when you combine all those things, it really sort of underscores the need to have a plan, to be able to have the life in retirement that's comfortable, to receive the kind of care at the facility or at your home where you want to receive it in the most comfortable possible manner. So today we're going to do an overview of what long-term care is, and sort of how it's different than medical care. We're going to talk about the need to plan and how that need is growing. We're going to discuss the family impact. So if you don't plan and it falls onto a family member, what that actually means to that family member. And then we're going to just broadly talk about long-term care insurance. We're not going to talk about any insurance carrier's product. We're going to just talk very broadly about the structure of policies, and ultimately, if you ever look at a statement, how to think about it and understand how the product works. And then we'll talk about some key takeaways at the end. So first things first, let's talk about what is long-term care. The most common question that we receive is, isn't it like medical insurance, or does it replace my need to have medical insurance? And the answer is no. The best way to the best way to understand it is long-term care is everything that is not covered by your medical insurance. Excuse me. So for example, when you talk about like medical care, you're talking about skilled care. So that is somebody who's providing the care that's in a white coat, or they have a stethoscope around their neck. They're a DO, they're an MD, they're a nurse practitioner, they're a registered nurse. They are qualified, licensed medical personnel that is helping with medically necessary care. That's covered by your medical insurance. We're talking about long-term care insurance. Oh, I'm sorry, not long-term care insurance. We're talking about long-term care. We're talking about custodial care. And the easiest way to think about that is like, think about how we all got into this meeting today. We all got ourselves up, out of bed, moving around our homes. We bathed ourselves, dressed ourselves, used the facilities, fed ourselves. When we become unable to do those things ourselves and we start needing someone to help us, that's custodial care, helping us with those activities of daily living that are not covered by your medical insurance. So the cost for medical care, or for custodial care, I'm sorry, is pretty significant. What you see from this chart is the monthly median cost in the state of Georgia. So if you look in this first box, this in-home care, this is where care generally starts out. And that's where you want it to start out. You want it to start out in your home. And really, most people, the goal is to be able to stay at home where you're comfortable as long as possible. Then you see box 2 is a community and assisted living. And then box 3 is nursing home facility. And the top number is the cost of care today. And it says 2021 because they have not yet compiled the end 2022 numbers. So it's a little dated, but it's pretty accurate. And then the number under it is the number it's projected to be in 20 years. So homemaker services being about $4,300 today, expected to rise to about $7,700 in 20 years. So you see kind of the spectrum of care with the homemaker services at one end and the other end, a private room in a nursing home facility where you're needing potentially round the clock care, the last step. You can see today that's $7,600 per month, pretty significant, and projected to be about $13,700 a month in 20 years. That's it. That's in the state of Georgia. The bottom here is the same statistics, but specific to the Atlanta area. And you can see that the cost is higher in a more populated, more affluent area. But one of the things that I found just as pretty unique in Georgia is that unlike some states where there's a very large disparity in cost from more rural areas to the metropolitan areas, while there is some difference, it's not quite as significant as you see in a lot of states. And while this may be, these numbers are certainly substantial figures for a monthly cost, excuse me, in comparison to some of the areas in like the San Francisco Bay Area, New York City area, Anchorage, Alaska, it's extremely high. So while this may look like a lot, it's not it's not outlandish compared to some other states. So so that's kind of, what custodial care is, and that gives you an idea of the cost monthly when you do start needing to receive care. So the question kind of becomes, well, what are my options to pay for? Like ultimately, who's going to pay for this care? Excuse me. So the first option a lot of people think of is, well, does Medicaid cover that? Medicaid is a federal welfare program that's administered by the states. And essentially, in most states, you have to have a resource limit of $2,000, meaning your assets have to be less than $2,000 in order to receive Medicaid. So for the people on this call, Medicaid is highly unlikely ever to be an option for you. Then you think of Medicare. 49% of people over age 40 believe that Medicare pays for their custodial care, will pay for their long-term care, but it doesn't. And it actually says it on their website For days beyond 100, Medicare pays nothing. You pay the full covered cost of services. So for the first 100 days, there's some cost sharing, but after 100 days, where your risk is really getting significant, Medicare can't be relied upon. Then you look at legislation. So there's federal legislation pending pretty much all the time, trying to address what is essentially a healthcare crisis in the United States. The last 17 Congresses have proposed a bill to address this in some way, shape, or form, and it never seems to go anywhere. So the states are trying to figure out how to address it at a state level, and the states that are in orange are states that are in some phase of research and development of a state-funded long-term care program. The first state that passed legislation was the state of Washington. And basically, they passed a law that's an uncapped payroll tax, 58 cents per $100 earned. And it kind of, their W-2 employees basically pay in like Social Security. You pay in for 40 quarters, you have the maximum benefit, which is $36,500. The reason that's significant to you in Georgia is that California is about to pass a very similar law. Again, $36,500. And states are picking it up little by little. But while, number one, there isn't any legislation that I'm aware of in Georgia, and there hasn't been any law that's passed, but even if that were to pass, think about the numbers I just showed you. $36,500 for a lifetime benefit, that's not $36,500 every year. That's for your entire life. $36,500 is horribly insufficient for 1 year of care, not to mention a lifetime. So really, that's a false sense of security, and it is most likely going to help those people who don't qualify for Medicaid but are lower income families. For the people on this call, Medicaid, Medicare, and legislation really are not options that you can bank on. So what are the options to pay for care? One is out of pocket. Out of pocket would essentially be akin to using your portfolio assets. And I'll just say that there's a couple of things that are difficult to time: the market and a long-term care event. And when you need those two things to coincide, it's a pretty significant gamble. In other words, think about like the last 24 months. There's been some really good months in the market. There's been some really bad months in the market. Imagine the market being down, in your portfolio being down 20 or 30%, and have to take 5-figure per month distributions from the portfolio. Distributions when you might still have a spouse who is still living independently and having the normal living expenses. Even if it wouldn't be catastrophic to your portfolio, it doesn't make financial sense when you can transfer that risk onto an insurance company. My guess is that the people on this call, you probably have collision coverage on your vehicles. Why? Because it makes sense to transfer risk. Although you could take a distribution from your portfolio and buy a new car tomorrow, you have collision coverage because it makes sense to transfer what is a catastrophic risk. In this case, a long-term care event is much more significant than replacing a vehicle, and it makes a lot of sense to protect your portfolio by transferring that risk onto an insurance company. Typically, when you look at a long-term care insurance policy, if you use the benefits, the return on your money is about 7 to 8%, and it pays income tax free. So that's a substantial benefit if you use the insurance. And government statistics suggest that 70% of people over age 65 are going to need care. So it's insuring against a risk that's both probable and quite large. And then the last option is your children. So if you don't have a plan, the default plan is your children. And nobody would knowingly leave that duty to their children, knowing the emotional, physical, and financial impacts it has on the next generation, which I'm going to speak about in a moment. But in general, the need to plan is extremely important in America today. And I use the word crisis, and I don't use that to frighten anybody, but it is a realistic viewpoint of where we are in America today. And you think, well, if the nation was in a crisis mode in terms of providing long-term care services to the elderly, why wouldn't that be in the news? And the reality is, it is in the news, and it's in the news pretty regularly, but it's not the fire at our feet. What you see in the news is things that are going to make you clickbait, and then you're going to see a lot of things about the elections, the war in Ukraine, etc. But these type of things are not the forefront, because it's not the type of article that's going to get people clicking. But it is something that when you're working through the financial planning process is really something that you want to have a plan for. So let's talk a little bit more about that need. So I mentioned earlier that the baby boomers are on the doorstep of needing care. The baby boomer generation is huge. So the baby boomer population is 70 million people. The youngest baby boomer is age 58. The oldest is age 76, with average nursing home admittance age being age 79. So there's a large percentage of people on the doorstep of needing care. And then when you look at the other generations, you've got Generation X and millennials, who together represent 137 million. So that's basically 2 non-baby boomers for every baby boomer. Now, we do have Generation Z that's still maturing into adulthood, who hypothetically will be able to help, but then you're still talking about a 3-to-1 ratio. How many people do you know who are professional caregivers? My guess is probably not many. And that number is shrinking. Why is it shrinking? It's a low-wage job. And when you think about some of the things that are required in that job in comparison to other low-wage jobs, you can see why it's not necessarily something that's easy to attract people into. Changing bedpans, giving baths, helping use the facility, helping getting dressed, versus waiting tables. And you go into restaurants, and how many restaurants you go into that are having staffing issues? Just that category of workers is just understaffed in general. To kind of highlight that, there was a study done by the American Healthcare Association. It was a study of nearly 1,200 long-term care providers, and 99% of nursing homes and 96% of assisted living communities said that they're facing some degree of staffing shortages, with 59% of nursing homes and 30% of assisted living communities categorizing it as severe. How severe? 6 states, including New York, New Jersey, Minnesota, Maine, New Hampshire, and Indiana, have had to deploy the National Guard to help with activities of daily living. So emptying bedpans, giving baths, distribute meals, obviously not what was intended to be the case, or not intended to be a core duty of the National Guard. So big population on the doorstep of needing care, shrinking a number of qualified caregivers really compounds the need to plan. So when I said at the beginning, we're in a point where if you want to receive the level of care that you want in the place that you want, you really have to get out ahead of it and plan for what that's going to look like. So the issue is being compounded by the fact that people are just living longer. So this is a chart that's provided by the Social Security Administration. And purple is women, life expectancy probabilities. Gray is men. The dark blue is couple, at least one living to a specified age. And the light blue is both living to a specified age. So you can see here that age 90, the probability of at least one person in married couple living to age 90 is 73% compared to 50% just in 1990. And then you look and see 95, there's a 46% chance one of two in a married couple are going to be around, and then 1 in 5 at age 100. Now, this assumes non-smokers in excellent health, but you have to be a non-smoker in excellent health to be able to get insurance. So not only do we have shrinking caregiving and a huge population of needing care, but that population of baby boomers is unique to other populations in that they're having a much more significant longevity. They're living longer. And those who have means have better access to healthcare. They have better access to quality food, better access to exercise regimens and things like that. And statistically, they live longer as well, which again underscores the need for care. So I mentioned a minute ago that your options are your portfolio, insurance, and if you don't have any plan at all, the plan defaults to your loved ones, your family. And I said that nobody would want to leave that burden on their family, knowing what that burden means. And I want to kind of show you statistically what that means. So this is a chart that shows the family caregiver benchmarked against the general public. And so what you can see here is that a family caregiver is 64% more likely to suffer from hypertension, 50% more likely to have obesity, 42% more likely to have a tobacco use disorder, 37% more likely to have major depression, and so on and so forth. You think, well, how many Americans are dealing with this right now? A mind-blowing number. 1 in 5 adults, 53 million Americans are providing unpaid family caregiving in America today. That number blows my mind. And I think most people are good. And I think a lot of people have the mentality of, like, I want to be able to help mom and dad. Mom and dad gave me everything growing up. And I want to be able to step in and provide them care and help them when they need it. And I think that comes from the heart. I think it comes from a really good place. But I don't think people understand what that really means. On average, a family caregiver is providing 24 hours per week of care. You think, okay, well, 24 hours per week, that's a lot, but I'm willing to do it for mom and dad. Well, how long? 94% of the time, it goes beyond a year. And 50% of the time, it goes beyond 4 years. So think about that, a family member trying to provide that kind of care. The most likely family caregiver starts out with the female spouse, and then it falls down to the oldest female child, who statistically is 49 years old. Think about life at age 49. Probably married, probably have kids that are involved in sports, that are maybe in high school or starting to go to college. Peak income earning years. And then having to provide 24 hours per week of care. More than likely, not going to be able to work full time. Cut back in hours. That means cutting back in wages. That means cutting back in retirement contributions. That means cutting back in Social Security contributions. Cutting back in employee benefits. Maybe the employer was paying a certain percentage of healthcare and health insurance that now is a lower percentage. And then you think about the impact on the individual's marriage and their relationship with their kids. And you can see that in combination with these physical and emotional tolls is something that's really a tough thing to ask a kid to do. And yet it's so likely to be the case because the planning is so infrequently done. And I think a lot of families believe that by doing this, they're saving money. Like, if I have my loved ones come in, then I'm saving money. But there are studies that show that it actually doesn't save the family money. It basically transfers the financial cost from generation 1 to generation 2, with the median cost to that 49-year-old female being $180,000. So it may save some money, but it's not but it's really just transferring the wealth. And that's where long-term care insurance comes in. To be able to maintain a relationship with your kids because they want to have a relationship with you, not because they want to because they have to take care of you. I can tell you in my family, I have a grandmother who 1 month from today is turning 101 and doesn't have long-term care insurance. And her daughter, my aunt, has had to move in and live with her and help her with her activities of daily living, which is really more difficult than caring for a child. You know, a child can a lot of times get themselves up out of bed, brush their teeth, use the restroom, pour themselves a bowl of cereal. Not the case when caring for an elderly person. I also had the other side where I had two grandparents that lived into their mid 90s, 95 and 96, that did have long-term care insurance. And the benefit was that the family went over there to see them because they wanted to see them and they wanted to spend time with them, not because they had to take care of them. And even aside from all the financial reasons to get long-term care insurance, to me, in just my experience with my family, I really think it's maintain a favorable relationship with your loved ones by bringing in care and having them still see you as mom and dad, not because they have to come in and take care of you. So I think when a lot of people think about long-term care insurance, they think that the goal is to pay for this, which is the nursing home. This looks like a Medicaid facility. This is not where you want to be. This is not why you get long-term care insurance. You get long-term care insurance to avoid this. The goal of long-term this is not the goal. The goal of long-term care insurance is to stay at home where you're comfortable and bring in care as long as you possibly can. The two biggest insurance carriers that had the biggest block of long-term care business, which is Genworth and Lincoln Financial, both provide statistics that 70 to 75% of their claims are paid for home health care, which I think is a huge reason to consider long-term care insurance, because that's where you want to be. You want to stay at your home as long as you possibly can. Now, in terms of how the products work, there's basically two types. Type number one is this traditional long-term care insurance. For about 20 years, up until about 2008 or so, traditional long-term care insurance was all there was. And when you see the negative press about long-term care insurance, this is what they're talking about. When these policies were sold, agents did a notoriously horrible job of communicating that the premium wasn't fixed. And so people received a relatively low premium and then got in their 70s and 80s and started receiving 40% rate increases, and the next year 60% rate increases, and so on and so forth. And if they pass away, there's no benefit. If they decide to quit, there's no benefit. And for those reasons, it's gotten a lot of negative press, and today only represents about 14% of the entire long-term care insurance market. Those highly publicized rate increases, in combination with the use it or lose it design, has really made it unattractive to a lot of people. Today, the lion's share of long-term care insurance is life insurance policies with long-term care insurance riders, which are called hybrid plans. I absolutely hate that description, even though it's technically accurate, because anybody that has any experience with life insurance views a rider as like, tacking on fries with your burger. You're not buying the fries, you're buying the burger, and the fries are just extra. That's not the case here. The reason people buy these hybrid plans is primarily for the robust long-term care insurance benefits. The fact that it has a death benefit is a secondary or even tertiary benefit. The way these plans work, the easiest way to understand it is live, die, quit. If you live, there's a big bucket of long-term care funds that you can use for your care. And generally, they're going to grow at a rate of inflation. If you pass away, there's a death benefit that pays income tax-free to your loved ones. And if you quit, you can get back some or all of your money. So I say some or all because you can design it to get back all if you want to, or you could take back like 70% and get a larger pool of long-term care benefits. But it's very customizable, and you can pay in a single premium, you can pay in 10 premiums, 20 premiums, you can pay your entire life, whatever is desired. So no matter what, these products are going to be used and the premiums are fully guaranteed. So the insurance company cannot come back and say, we want to raise you by 40, 60%. The premiums are locked in, not just for the amount of the premium, but also the duration. So if you do 10 payments guaranteed, they can't come back after the 10th and ask for an 11th by the terms of the contract. So the way that one would qualify for claim is one of two ways. And this is pretty much every insurance carrier. You qualify for claim by being unable to perform 2 of 6 activities of daily living as attested to by your physician. So those activities of daily living are eating, bathing, dressing oneself, using the facility by oneself, transferring, which is like moving from a bed to a chair, incontinence, that's being able to maintain bladder and bowel function. Being unable to do 2 of these 6 qualifies an individual for claim, or having a cognitive impairment. So like, dementia, the most common example being Alzheimer's. So that would qualify you independent of the 2 of 6 activities of daily living, that cognitive impairment. And basically, here's how the policy structure works. They all work this way. The way that you receive money is either going to be an indemnity style or reimbursement style. So indemnity means once you qualify for claim, you get the monthly maximum. So if your monthly maximum is $5,000 per month and you qualify for claim, the insurance company just starts sending you $5,000 check every month. If it's reimbursement, you or your family members are submitting receipts to the insurance company, and they're reimbursing you up to that monthly maximum. Now, in a historic market, most plans are reimbursement because historically they're a lot less expensive. Today's market is very much an anomaly where indemnity plans today are priced very similarly to reimbursement plans. Monthly benefit, that's the monthly allotment that you get per month. In my example, is $5,000 a month. The benefit period is generally stated in months, and that's how long you can be on claim. Is generally 36 to 48 months. The elimination period is like your deductible. Like you have a car insurance deductible, that's your financial responsibility before the insurance kicks in if you get in a car accident. This is the same thing, but instead of being in terms of dollars, it's in terms of days. It's the amount of days that you are financially responsible for your care before the insurance company kicks in. A lot of times it's a 90-day elimination period. A lot of insurance carriers have 0-day elimination for home health care, which is really, really nice. And then inflation protection. The most common age for a long-term care insurance purchase is age 57. So there is a good 25 years or so before the likely time of claim. So inflation protection helps to make sure that the level that by the time you're on claim, you're getting a commensurate level of benefit as you are when you buy the policy. So most common would be 5% compounding interest on, say, a $5,000 or $6,000 monthly benefit. So the key takeaways here are, number one, understand with long-term care insurance, it has a pass-fail design. I'm not saying long-term care insurance is the solution for everybody. It might be a solution for you. It might not be. The most important thing is to have a plan. But I think it is important to explore options while you're young and insurable, because we have a lot of people who come in and have a health event and that scared them. And it's like, oh, wow, I'm having memory issues, or I have a knee problem or hip problem or whatever it might be. That health scare that led them to want to have a conversation about long-term care insurance is actually disqualifying them from being able to get it. It's not like, for anybody that has experience with life insurance, like life insurance, you have standard rates and then 12 to 16 tables under it, where if you're willing to pay, a lot of times you can get life insurance. Long-term care insurance is you're kind of in or you're out. It's like a pass fail. And you can see here the the number of applicants that are declined by age. So you can see by age 70, you have nearly half of all applicants that are declined by health. By that time, the premiums are getting pretty high. We always encourage people to consider it in the early 50s. Early 50s, young, insurable, you get a lot of leverage out of your premium dollars. And it's a really good time to start exploring that even into your early 60s. The most common funding methods for long-term care insurance, number one is earned income. So higher income earners, let's say, you have somebody who's 50 years old and, you have peak earning years up until age 65. There's a desire to have the long-term care insurance paid up before entering retirement. You do 10 or 15 payments, have it paid up by retirement. That's a very common method. Number two is low yield assets. So client has CDs, money market accounts that are low yield. And they've repositioned it into a hybrid long-term care plan where there's still the in case of fire, break glass feature to it if you really need to get to it. And then the third option is existing life insurance. This is a common one where you have somebody who bought a permanent life insurance policy, a whole life policy, whatever it might be, in their 30s when the children were young. It's like, I want to make sure that if something happens to me, that my kids are protected. But now the need is a little bit different. Kids are adults. They're financially independent. The biggest risk to the family isn't so much passing away too soon. The risk to the kids is now what happens to them if I live too long. And exchanging that existing cash value into a hybrid life and long-term care policy can sometimes fund the entire policy, and it's the out of pocket doesn't hurt quite as much because it's already money that's been earmarked for a different purpose. It's just kind of repurposing the money for what the need is today. And so with that said, I'm happy to answer any questions that you might have. I saw a couple might have popped up here, so I'll pause here and help address any questions you might have.
Thank you so much, Brant. That was fantastic.
Thank you.
Really great information. I think that I've taken away a lot of great information here, so I know our clients have as well. We have had a few questions come in. And again, if anybody else has some questions, be sure to just put those in the chat box or in the Q&A box, and we'll go ahead and answer those. The first is long-term care insurance worth it? I could save money on the side to use for long-term care expenses if needed to in the future, couldn't I?
Yeah, so the benefit of long-term care, if you compare it to just putting money on the sideline, if you use the long-term care insurance, which is probable, the internal rate of return, so that what you'd have to get in another investment would be 7 to 8%, and the long-term care insurance pays income tax free. So you'd have to be in the market, you'd have to be taking a lot of risk in the market, and you'd have to be in the market for a long time to match the long-term care benefits. So because of those reasons, and again, because it pays income tax free, it'd be very difficult to beat it with a side fund.
That makes sense. Thank you.
Yep.
I've heard a lot about continuing care retirement communities. So I think these would be when you come in and you buy property and then you move to assisted living eventually and then memory care. Is that right?
Yep.
Okay. So when will the long-term care policies start paying expenses for that care? And what portion of those expenses would be covered by the long-term care policy?
Yeah. So if you're an independent living, and the idea is that you're caring for yourself, and when you become unable to care for yourself is when you start moving through that sort of spectrum of care. The way you qualify for claim is by being unable to do 2 of 6 activities of daily living, or by having a cognitive impairment, and it's going to pay for helping you with again, all the ways that we got into the meeting today. When you can't do those for yourself and you need somebody to help you, that's what it's going to essentially pay for. It's not going to pay for anything that's medically necessary. That's why you still need medical insurance, but it's going to pay for making life livable, essentially.
Okay. And how difficult is it if you still can do those 6 things, but you're having cognitive issues? How difficult is that to get that assessment from a physician in order to get that policy to pay?
It's not extremely difficult. One of the things about the claims process in general with long-term care is that it's much more favorable in boutique than most claims processes, like with your auto insurance, where you might not have the best experience. The largest long-term care insurance companies, and there's not that many, like there's, dozens and dozens of life insurance companies. There's only like 5 or 6 companies that make up nearly the entire long-term care market. They all have concierge services where once you file a claim, they have a concierge that helps coordinate with the doctor, with your facility, to make sure that they're helping with the paperwork. They help the family find elder care attorneys. They help coordinate the billing and the reimbursement. They help find caregivers for home health care and things like that when necessary. So it's actually generally a much more favorable experience than what you're probably accustomed to with claims from other types of insurance in general.
Those can be hard. Okay.
Yeah.
I have an existing long-term care plan and the premium keeps increasing. What can I do to keep my premiums manageable?
Yeah. So just to recap, so traditional long-term care is historically was the only type of long-term care around for about 20 years. It's all it was. And they have those rising rates. I'm not sure we've ever recommended anybody replace one, even though they've had 40%, 60% rate increases, because they were priced so low to begin with that even with those rate increases, it still could be a lot less expensive than what's available today. One thing that we can do is help kind of work with Elevate and the client to kind of think through, what is this statement actually saying to me? So they usually give you like 4 options. It's like, well, which one should I do? Well, one of them saying you pay more money, and the other ones are saying you pay the same money but take less benefit. So we can kind of help you think through what the best option would be, but more than likely you probably want to keep that plan because it's probably in your family's best interest.
Okay, thank you. As I review my options for long-term care insurance plans, what are the most pertinent reasons to lean toward either the traditional or the hybrid?
Yeah. The hybrids have become much more favored in the market because of the guaranteed premiums, the certainty.
Right.
No matter what, if you put premium dollars towards a hybrid plan, you are 100% going to use the benefit. So if you live and the probability of needing long-term care, you'll receive benefits from the policy to pay for your long-term care. If you pass away, there's an income tax-free death benefit that pays your beneficiaries. If you just want to quit because you have an emergency or there's a better mousetrap that comes along, you can quit and get your money back. That's very different than a traditional long-term care insurance plan, where most of them do not have anything, return of premium if you want to get out, no death benefit, and you have rising non-guaranteed premiums. Now, on the traditional plan, a lot of times the premiums will start out lower, but they're going to increase in the future. Every insurance carrier has increased them. So you kind of have to account for the variable of not knowing what those future rate increases are going to look like.
Right. And when you showed that slide that looks out at 2041 and beyond at the cost of care, I can see why those might go up. So
yeah, staggering.
Last question is, I'm interested in long-term care insurance, but I would like to stay at home as long as possible before moving into an assisted living or a nursing home. Would insurance cover at-home care?
Yeah, and most of the claims are for at-home care. So the number one goal for your long-term care insurance should be keep me at home where I'm comfortable. Unless you want to be in the facility that you described, where you have the continuum of care and you like the independent living and being around other people, and that's great. But ultimately, stay in your home as long as you can. And if you have long-term care insurance, it makes you attractive to home health care facilities. even more so than maybe a portfolio asset, because there's only one way long-term care insurance can be spent. And that is to that home healthcare facility or that long-term care facility. They know that that's a sure thing, making you very attractive. So if there's limited caretakers and you have a long-term care policy, it makes you a desirable and attractive candidate to bring in that in-home care.
Good to know. Okay. There is a little follow-up to that. Somebody would like to compensate an adult child for providing me with care in the home. Would the long-term care policy cover that?
It depends. If it's a reimbursement plan, it would not. So they'd have to be a qualified caregiver. If it's an indemnity style plan, remember with an indemnity style, the insurance company, as soon as you qualify for claims, they're just sending you a check every month for the maximum monthly allotment. As long as that amount is under the HIPAA per diem limit per month, which is quite high, then you can pay whoever you want. And maybe it's just helping, if they're coming in and helping with laundry, helping to mow the lawn, things like that. But I would encourage anybody not to have their child be the primary, to at least have it shared with somebody who can come in and provide some professional support, because it's just a lot. It's just a lot to ask of a loved one.
Very good. Well, I cannot thank you enough for your time today. You've been great, very thorough. If we do have questions that arise, we will send people your way. You can email questions to me at marketing@elevate-wealth.com. And we do these educational webinars every month. Next month, our founder, Chuck Vickery, will be covering Social Security. So that's always a good one. You can find all of our webinar listings on our website at elevate-wealth.com. And then you can also find the recording to this on our YouTube channel later. It will be, if you go to YouTube and look for Elevate Wealth Advisory in Athens, Georgia, you'll see it there. And just please share that with family, friends, anyone you think might benefit from this talk. We really appreciate you, Brant. Thank you so much.
Thank you very much.
All right. Bye, everybody. Have a great afternoon. Bye.